Hello, everyone, and welcome back to Top Link. Today, we're diving into a topic that has been making headlines and causing concern across the nation: the looming economic crisis in the United States.
It's possible that this time is really different, and the reason is there's just so much excess demand, really, in the labor market.
I mean, it's been amazing how resilient, in a way, the consumer has been to this inflationary shock.
The U.S. economy has been on relatively solid footing heading into 2024 compared to the previous year. Inflation has cooled.
People are still spending, and that has been important to the economy.
Labor markets have remained stable, and the Federal Reserve has opened up to the possibility of decreasing interest rates. Despite these positive signs, there are still risks that could lead to an economic downturn in 2024. Some of these risks include political outcomes, such as a close and contested election, which could result in social unrest and economic turmoil. Additionally, the Federal Reserve's tightening policies and the looming threat of a government shutdown also contribute to concerns about an economic slowdown.
They're the ones that's charged with managing the currency in circulation in our economy.
Despite these challenges, many economists and investment analysts expect the country to maintain a strong job market and stable labor market in 2024, with consumer spending trends supporting economic growth. However, the New York Fed's recession probability model indicates a 51.8% chance of a U.S. recession within the next 12 months. To truly understand the current economic situation in the U.S., we need to look at a series of factors that have been building up over time. From the housing market to inflation, there are multiple elements contributing to this potential crash.
For some of us, spring cannot come soon enough, and for potential home buyers, it could bring a much-anticipated rate break.
Stay with us as we break down the complexities and shed light on the different aspects of this economic puzzle. However, factors such as political outcomes, including major elections, and the Federal Reserve's tightening policies continue to pose risks for the economy in 2024. While some economists predict a soft landing or a mild recession in 2024,
we are in a different environment than what we've experienced over the past 15 years.
Others believe that a recession is still possible due to factors like inflation and interest rate hikes. The outlook for the U.S. economy remains uncertain, with varying opinions among experts on the likelihood of an economic crash in the coming year. As the economy faces challenges and potential risks, it is essential for policymakers and investors to stay informed and prepared for unexpected economic developments in 2024. The analysis of how political outcomes, such as a close and contested election, could lead to social unrest and economic turmoil in 2024 is a significant concern for the U.S. economy. The close and contested election in 2024, with President Joe Biden and former President Donald Trump running neck-and-neck, could lead to social unrest and economic turmoil if the results are not accepted by all parties involved. The potential for a government shutdown, which could result in significant economic impacts, is also a concern. The outlook for the U.S. economy remains uncertain, with varying opinions among experts on the likelihood of an economic crash in 2024. The Federal Reserve's tightening policies could contribute to an economic slowdown by exerting further restraint on the U.S. economy in the quarters ahead. The effects of the Fed's current tightening cycle are estimated to amount to downward pressure of about 3 percentage points on the level of real gross domestic product, GDP, and 2.5 percentage points on inflation. While the majority of the effects on output and inflation have already occurred, the policy tightening that has been implemented will continue to impact the economy, potentially not meeting the Federal Open Market Committee's (FOMC) inflation goal, leading policymakers to consider further action. The Federal Reserve's actions, including raising short-term interest rates by over 500 basis points since early last year, play a significant role in firming the stance of monetary policy to support maximum employment and price stability goals. Additionally, the reduction of the Fed's securities holdings and adjustments to interest rates contribute to tightening financial conditions, which could lead to a slowdown in economic growth in 2024. A government shutdown in the U.S. could have significant impacts on the economy, with estimates suggesting that each week of a shutdown could reduce GDP growth by 0.1 percentage points. The economic consequences of a shutdown include delays in government spending on goods and services, resulting in decreased final demand and a reduction in pay for furloughed federal workers. The U.S. economy avoided a recession in 2023, but uncertainties persist regarding the outlook for 2024.
A new year means a new chapter for the economy. 2023 was full of unexpected ups and downs. So what is in store for 2024?
While experts suggest a soft landing or mild recession is possible in 2024, there are contrasting views on the likelihood of an economic crash. Factors such as inflation, interest rate hikes, political outcomes like a close and contested election, and the potential for a government shutdown contribute to the uncertainties surrounding the U.S. economy in 2024. The U.S. job market and labor market stability are expected to remain strong. The unemployment rate has remained below 4% for nearly 2 years, and job growth is resilient but slowed. The Bureau of Economic Analysis preliminary estimate for growth in the fourth quarter of 2023 from the same quarter a year ago was 2.4%, up from the previous forecast of 1.5%. Experts have varying viewpoints on the U.S. economic situation, particularly regarding the potential for a recession. Initially, there were concerns about a recession in 2023 due to economic indicators like a contraction in economic output and rising inflation. However, the economy grew by 3.1% in 2023, inflation decreased substantially, and unemployment remained low. Some economists, like Michael Gapin from Bank of America, initially forecasted a mild recession in 2023 due to fading fiscal support and inflation shocks impacting household spending power. The Federal Reserve's projections did not show GDP contracting annually, and there was a notable divergence between earlier recession concerns and the current economic strength. The U.S. economy demonstrated resilience, with growth rebounding to a rapid rate and remaining above 2% since then.
At home, America's economy exceeded expectations in the last quarter, boosting hopes for avoiding a recession.
This positive momentum has led some economists to believe that the U.S. economy is more durable than expected and may even be picking up speed. Overall, while there were initial fears of a recession in 2023, the U.S. economy has defied expectations with strong growth and low unemployment rates. The shift in forecasts towards a soft landing scenario for 2024 reflects the evolving views of experts as they navigate the complexities of economic indicators and trends. The uncertainty and disruption caused by a prolonged shutdown could dent consumer confidence and have lasting effects on the economy, especially when combined with other economic challenges such as high gas prices and inflation. Thank you for joining us on Top Link. If you found this video insightful, don't forget to give it a thumbs up and share it with your friends and family. And if you haven't already, hit that subscribe button for more in-depth analyses and discussions on pressing issues. Until next time, stay informed, stay vigilant, and take care.